Hi there, this is Mike Koval.
And Stacey Acevedo.
And we are here together to give you your investing education bonus DVD on investing in covered calls. Fantastic course.
You know what? And this is something that everybody should do. In fact, it's so funny. When we teach people how to write covered calls, people say, well, how come nobody taught me this before? So you're going to love this.
I think so, too. But before we get into it too much, let's make sure we cover the disclaimers that we are not licensed brokers. Our job is not to take your money and to invest it for you. We are educators, and we are here to teach you to capitalize on the current assets you already have and to make income off of those assets. So that's what we're here to do. So disclaimers. Also, proprietary information. That this information, no part of this presentation may be copy recorded or rebroadcast in any form without prior written consent of SuccessStockMarket.com. So we're going to use the Success Stock Market website all throughout this presentation today. It is loaded with just some fantastic features on here, including all kinds of automated buy-sell signals, commentary, homework, cover calls, and it has absolutely some of the best internet market searches anywhere you're going to find anywhere across the internet.
It's a very comprehensive website.
Absolutely.
And what we're going to focus on today is we're going to focus on how to use this website and specifically kind of get you started with these covered calls with stocks you may already own.
Yep. So let's get right into it. Right now, there are billions and billions of dollars unclaimed each and every month from individuals just like you who have some type of a brokerage account. Whether that's an individual account, a joint account, or any kind of retirement account like a simple IRA or Roth IRA, any kind of retirement account, there are just trillions of dollars of assets sitting within those, just sitting idle. And most people just don't understand this, but each and every month, someone is willing to pay you cash to buy your assets at a premium. I mean, think about that. You've got assets that are just sitting there in some type of a brokerage account or retirement account, and someone is willing to pay you cash each month. They're just knocking on your door and saying, I've got cash for you, and yet we've just never been taught how to open up the door and take that cash.
So when we're taking a look at covered calls, we're saying you have stocks in your portfolio or similar type of equities, which we'll get to in just a moment, and by them willing to pay you cash, they're saying that they're willing to give you an options premium, which we'll get into in just a moment as well.
You're just diving right into this here.
I am. I wanted to tell them what it is.
Yeah, but what we want to tell you is that if you've got some kind of asset in your portfolio right now, if someone's willing to pay you cash to buy the asset every month at a higher price than it currently is today, whether it goes up or not, they'll give you the cash.
That's a nice paycheck.
Yeah, it is. So did you know that if you have stock or even stock funds, something like mutual funds, that an options market maker will pay you cash to buy your stock at a higher price? Even if that stock does not go up in price, they'll still give you the cash, and they'll do it every single month of your life that you own that asset.
And really, the best part is you're already owning the stock anyway, so why not collect that monthly cash flow? And really, you don't even want the stock to move that much. If it goes up, great. And we're going to show you a few examples in here, and you'll have access to this with your website. And as we go through this bonus DVD, you're going to see why you're going to probably start taking action pretty quickly. And then, of course, when you come to our class.
Well, imagine that, a paycheck in January. Could you imagine an extra paycheck in January, February, March, or how about April, May, June, July, August, even September, October, November? 12 months out of the year, someone's going to give you cash to buy something you own at a higher price. Whether it goes up or not, you get to keep that cash.
Wow.
Yep. I know it sounds kind of strange, but let's put it in a specific example that you're probably already familiar with. As an employee or as an individual, hopefully we're born, and we're raised, we go to school, maybe get some kind of an education, whatever it might be, and then we're taught to go out and get a job and to kind of climb the corporate ladder and then maybe invest in the American dream and buy ourselves a house. And we put our money into the house and we keep adding money to that house, and hopefully the house will grow in value through time. And so by the time we're ready to retire, hopefully it is paid off, and now we have a nice large asset that we can use for our retirement. So we're actually investing in our home for long term, for trying to get some growth. That's what an employee does, and they know that they're going to get paid because they have a job to pay their monthly bills. An investor looks at the same asset but looks at it just a little bit differently. They look at the same house. They look for the growth. They want that house to appreciate in time over the next few 10, 20, 30 years, but they also want that house to produce income so they don't have to get that JOB, go out and have that just overbroke the job. So the investor looks at the same thing that the employee looks at, long-term growth, but they also want the long-term growth and some income. And so you think about that. If you bought a house for an investment, you're going to go ahead and rent it out each month. Someone's going to pay you money to live in that house. You can even do a lease to own and have them pay you money each month to live in the house with a lease to own at the end of the contract.
And it's really only just one more step to what you're already taking. I mean, you already have the money and the assets, sitting in your account. So what we're going to teach you is by just taking one or two more steps, you can turn those assets into more, not just growth, but that growth in income coming in. And you can choose and take that cash out and use that, or you can leave that to continue to go back in and grow and buy more stocks.
That's right. So in the stock market, an employee looks at growth. They just say, I'm going to go ahead and buy that stock or that mutual fund, and I'm going to wait for it to grow in value, and hopefully if I just keep adding money to my portfolio, over time my portfolio will grow, just like the asset for the house, and hopefully in time it grows.
See, well, hopefully is the key word there.
Hopefully is the key word here.
And part of being a really good investor is someone that says, I'm going to take the hope strategy out and I'm going to actually plan. I'm going to specifically go forward and do something that has growth and income. And that makes you an investor to kind of think outside the mindset of the employee, more toward the employer.
So the investor looks for both growth and income. So we're looking for that same asset to grow, but we're looking for income off of those same stocks or those same funds that we might have in our account. So we're looking for long-term growth, and we're looking for those items that are giving us long-term growth to produce income. Just like we're looking for that house to produce monthly income if we rent it out, we're looking for the same thing with our stocks. We don't want just the growth, we want the growth and income. And so now we're trying to change our thought process. So if we have those assets in our portfolio, they're ready, willing, and able to start to provide us some type of an income.
So this is it, guys, where we change our mindset. We go from just a standard, growth employee mindset to now, how do you take control and start growing this yourself? Now, just what a covered call is, let's first explain it.
So a covered call, if you own a stock in your account, somebody will pay you cash to buy it at a higher price next month, whether it goes up or not. That's what a basic covered call is. So we're going to
cover your stock. We're going to cover your stock with a call option.
So we're going to explain each step for you and teach you how to read a chart.
You're going to be excited. This is going to be really cool when you see this.
Show you how to make some money. So here's a basic stock example. This one here we have to look at is ENSCO, ticker symbol ESV. Currently, when we took this, it was trading right around $58.70 per share. That was the price that our stock was trading at. And it was up around 47 cents here for that day, with volume of about 549,000 shares traded that day. That's what we're looking at. Now, on here, we've got three sections. This top section right in through here is the pricing graph. Then we have some indicators, which are these bottom two right down here. We're going to cover each of those. But let's just kind of start with the pricing graph and see what it is that we're taking a look at.
First of all, I want to take a look at this chart, folks. This is the stock that people buy. Almost 550,000 shares traded hands. But look at the trend of this stock the past several months. Absolutely sideways.
Yep.
So if somebody's holding this in their account, you're really making nothing in those past few months. But now we're going to show you how to take a stock that you might like, that maybe is very fundamentally sound, and start turning this into more cash flow.
All right, so here's our stock. Each of these little items on here one day is one trading day that we're taking a look at. So each of these is one trading day. So if you look at these all added up through here, we're looking at a 6-month chart. This right here is 1 month of time. This right here is 1 month of time. This right here is 1 month of time right here. So each of these is months. Well, right now we're looking at a 6-month chart, and this would be 6 months ago, way down here towards the very end, and right here would be today's closing price right up through here. That's today's closing price. And so each of these items, as you'll learn when you come to your class, we'll teach you how to read these charts. But right now, just understand, this is a 6-month chart. This is 6 months ago, and this is today's closing price right now. And
so
you can see that it's right there around $58.70 per share. So that's what we're looking at. That's the top part of our graph for us. The bottom part of our graph down through here, we've got indicators. Now, an indicator, the two that we're looking at, the Colville indicator and the MACDs, are both called oscillators. And what they do is they help us identify a stock's trading pattern to see if that stock is in some kind of an uptrend, a downtrend, a sideways trend, but just tell us where the stock is within its current pattern. So here's how you would read these here. And so we've got our red and green arrows, and I know you learned a little bit about this from the large arena event you went to, but the red and green arrows just tell us if a stock is overbought or oversold. So anytime our stock, and if we just take a look at our trading pattern here, our stock went from this low down here and went up to about this high right up and through here. And then it started to kind of pull back right through here. Anytime the stock goes up and then it pulls back, all stocks ebb and they flow. They go up and they go down, and they go up and they go down. Anytime that they go up a little bit, they're likely to pull back a little bit. And so we kind of think of it as like watching the tide at the beach. When you're at the beach, even though the tide might be coming in, it's pushing in further and further and further. It still pulls back a little bit every once in a while, and then pushes in further and pulls back, and pushes in further and pulls back.
And that's called a trading channel in the stock. And we're going to teach you how to read the trading channels when you come to our class, but it's pretty key when you're looking to write cover calls on stocks that you're owning in your portfolio.
So anytime our stock's made a little bit of a rally higher, we know that even though it might still go higher, it's going to have a little pullback before it moves higher and then pulls back and then moves higher again. So anytime your stock is ready for that little pullback, our oscillators will also give us some red arrows saying that your stock is a little bit overvalued at its current position and it's ready for a pullback.
And the first oscillator we have, the Colville indicator, is fabulous. This is a proprietary indicator that we've actually taken, and throughout the decade, the past 10, 12, 13 years, we've specialized and focused on these numbers to narrow them down to get a really quick read on the momentum of that stock.
Now, sometimes they'll match up pretty closely to the MACDs, which are below that, and sometimes they'll be completely different. But what we're trying to see here is anytime that these are high, and this is the low part, and this is the high part up here, anytime that they're high and they start to drop, we get a red arrow. That usually means your stock's about to pull back a little bit. Anytime that they're low, right in through here, and they start to bounce higher, that usually means your stock is also about to rally. And you can see how your stock went right up in time right in through here. So we had a nice little rally as the stock moved up and up and up and up. And at the same time, my Colville indicator moved up. Now, whenever your Colville indicators are high and then the MACD start to pull back as well, usually means that your stock is about ready for some kind of a pullback. And it doesn't always have to pull back, but it just means, hey, your stock is already overbought and ready for that pullback. And then whenever they're low and you get 3 green arrows, here's a green, and a green, up our stock went to a little high. And right now we're starting to get 3 red arrows, kind of came up, pulled back a little bit, pulled back to a little bit of a floor. We're going to teach you how to read charts in great detail when you come to your live 3D class. We'll teach you in great detail. But right now we're just kind of showing you some basics so that if you're looking at a stock to do some covered calls with, it'll make much more sense for us. So anyway, here's what we're after. Our stock right now is starting to rally just a little bit. So it's pulled back, rallied, pulled back to that same level. Now that's called a support level, which just means that that's going to be a new floor for the stock. And we're starting to rally off that floor right now with 1, 2, 3 green arrows, and we're starting to rally to the upside right now. So hopefully that, I know we've marked up this chart quite a bit, but hopefully that makes it a little bit easier to understand the chart.
Folks, is all you need to look at is on the left-hand or right-hand side of the chart, is all you need to look at what's the most recent arrow. As long as the most recent arrow in each category, the MACD, the Colville indicator, and the price chart, as long as they're all green, that's kind of a go. Yep,
that's a go for us. And we see our stock is just starting to move higher at the exact same time. So for us, if we're looking at the stock, it looks like stock's moving higher. Now, if you had to guess how high it was going to go, you'd say probably at least up here to 60, if not higher. But the stock's kind of starting to rally to the upside right now.
And here's something that it looks like it's heading up, but it's really sideways. The channel is overall sideways. So let's say it just stayed in this channel for an entire year. The average investor would get nothing off this. But we're going to teach you now how to kind of take control and turn this into a growth and an income investment.
So here's your channel. You can kind of see it moving sideways now for about the last 4 months. It goes up to the ceiling, down to the floor, up to the ceiling, down to the floor. So it's kind of moving back and forth. So there's our channel. But that's kind of how we read a basic chart. We're going to cover in great detail some more specific items for you to look at your 3-day event that you go to.
So let's say if the stock is $58.70.
So let's see how this covered call process would work. So we see our stock at $58.70. Right now, an options market maker, and here's an options quote.
This is an options chain that you're going to see on the website.
And we're going to teach you how to read this. Right now, an options market maker, if we're taking a look at this, will pay us $2.65 per share. Right now, they'll pay us $2.65 per share to buy the stock at $60.
Nice.
Can you believe that? The stock is only at $58.67. So why would someone pay us right now? And this, if there's a
today,
bid, this is the bid and the ask. As long as the price is actually listed, that's the price they're saying right now. If you place a trade, you're going to get that price because that's the current price. So right now, if you sell this option that you don't own, if you just sell the option, an options market maker will give you $2.65 a share to buy the stock at $60, whether it goes there or not. So if you own the stock and it's in your account, you call up your broker tomorrow and say, I would like to sell the January $60 call options. The broker will say, okay, we'll do that. And you'll go into your account, go $2.65 for every single share you have in your account. That's your cash at that point for the rest of your life. You never have to give that cash back.
And you get it goes in your account in 24 hours. It goes into your account. So your stock is at $58.67. They're going to pay you
$2.65
to take it away at $60.
$2.65 to buy that stock from you at $60. So if you had 100 shares, imagine that. If you had 100 shares, that's $265 every single month for every 100 shares that you own, just because you own it.
And the key is you have to have at least 100 shares.
Yep, we're going to talk about that. So you think, well, that sounds kind of strange. So what is an option? How does this option thing work? I've never heard about that. How come nobody's ever taught me about that?
I know.
And we'll tell you exactly why no one teaches you this when you come to the live class. But basically it just boils down to it's in nobody's best interest to teach you, because if you do this, that means that you're collecting the money. If you don't do this, that means they're going to collect the money and they're going to do it. That's why when you're taught to buy and hold stocks, you're taught to buy and hold stocks. Because as long as you buy and hold those stocks and don't do anything with them, somebody else is able to make money off of your account. Think of it like your checking and savings account. You know, when you put money in your savings account, they give you interest in the savings account.
Like a 0.5%.
0.5%. Put that same money in your checking account, they won't give you any money at all because you're using the money. But if you put in your savings account, long-term buy and hold, somebody else can use that money, so they'll pay you a little bit. That's the same thing here.
Yeah, and the bank's lending out your money at 8, 9, 10, 20%. So
the reason nobody tells you about covered calls is because they don't want you to do it. Because if you do it, then you're taking the money that they're going to make out of your own account from you.
And this is really, it's such a simple step to go from, people go, oh, sounds so scary. It's not. This is one step from you already own the stock. You're now just covering your stock with the call option. 24 hours cash goes in your account. This is a phenomenal strategy.
And you can do this every single month. Every single month. And think about this. It's even a scarier thought. Now you start thinking, okay, I'm X amount of years old, and I've owned stocks or some funds in my account for the last 30 years.
Whoa. And think of how many years you didn't
every
get
single
it.
month for the past 30 years, I could have been collecting cash, and nobody told me about it.
Well, the good news is I'm not that old. You are, but...
All right, so let's talk about what is an option. An option is a contract that allows you to buy or sell a stock at a set price before the contract expires. All options contracts generally expire every month, so they're good for about 1 month. And so right now someone will pay you that $2.65 to buy your stock this month or next month based on which month you decide to go back and sell it.
And we're just going to keep it simple. We're going to do it. We're going to focus on the call options. And by us selling a call option, we have a contract. We're entering into a contract that if our stock goes to 60 or above, sure, they can take it away at that $60 price.
So an option is a contract that allows you to sell. That's what we're taking a look at here, that allows you to sell your stock at $60 before that contract expires next month. That's all an option is, and somebody will pay you money for that right. Now, if your stock goes way above 60, they'll probably want to buy the stock at 60. So then you say, well, wouldn't the drawback be, what if it goes above 60, I'm going to have to sell it at 60? Yep, but we're going to teach you exactly when to sell it, because just like we looked at a stock previously, stocks don't go up forever, and there's going to be some signals that tell us your stock's about to pull back. And right when your stock's about to pull back is when you want to turn around and collect that cash, because now no one's going to want to buy that stock as it goes higher. So you're going to own it anyway, so you're just going to collect the cash. Now, in order to do this, this is a fantastic strategy. It's a very, very powerful strategy. In order to do this, I mean, think about this. Think if you're getting ready to retire and you've got a couple $100,000 in your account, you might be able to make an extra $6,000, $7,000, $8,000 every month by writing covered calls on your stocks. No more Walmart greeter here.
Nope.
All right. So set up accounts. In order to write a covered call, you're probably going to have to alter your current brokerage account, whether it's a regular brokerage account or an IRA. You're probably going to have to alter it, and you're going to have to say that you want to trade options. And so you're going to fill out an options contract so that you can be approved to trade and to write covered calls. And that's all it is. This is a very basic contract. All you really have to do is say you want it, and they give it to you.
That's right. Yeah, anybody can get approved for it, whether you have experience or not. Because honestly, the risk is big deal. You sell your stock at a profit. Someone paid you money to sell your stock at a profit. That's why anybody can do this.
Just call your brokerage firm and say, I want to be able to write covered calls, and usually you can just do it right online on your brokerage account online and make the adjustment right there. Let's cover some basic elements of an option. So we've talked about how beneficial they are. Let's talk about some of the basic elements.
A few things you have to know before you actually enter into the option. One of the most important things is when you're trading an option, you have to trade an option. They control 100 shares of stocks, one contract.
Yep. So if you're going to write a covered call option, you have to first own 100 shares of stocks so you can sell one options contract. Each options contract is good for 100 shares. Options have an expiration date. And 95% of all options these days expire monthly, and that's at 11:59 a.m. on the Saturday that follows the third Friday of the month. It's kind of a weird one because that's when the options market makers clean up all the accounts. But really for us, on the third Friday of the month, at 4 p.m. Eastern Time. Markets are open 9:30 a.m. until 4 p.m. So at 4 p.m. Eastern Time on the third Friday of the month, that option now is done with at that point of time. So options have an expiration date.
And the reason why we say Saturday is because if you do get assigned to this, you'll see that on Saturdays when they'll actually take the stock out of your account.
Correct, which means if somebody buys a stock, they'll do it on that Saturday. If we have a strike price, it's the price you agree to either buy or sell a stock at. And the premium is the amount of money you receive for buying or selling the option. So if we kind of go back to where we were previously, and we take a look and we'll say that a contract allows you to sell a stock at a set price, and we were looking at our choices here, $60 for our stock, on or before the contract expires, that would be the third Friday of the month. And then you receive a premium, which would be the amount of cash you receive for doing that type of a trade.
And since you're the seller of the option, you have the obligation to deliver that stock at that price, at your strike price.
All right. So premium, amount of money received, strike price, the strike price we're agreeing to strike the deal or sell the stock at when the option expires, and each option's contract is good for 100 shares. It's good to know that. So if you tell anybody that you're writing covered calls on the stock and you can't even tell them how many shares are in that, I mean, it's good to have some basic knowledge.
Yeah.
We at least kind of sound like we know what we're talking about.
Yeah, and so if you have 82 shares, you're going to have to go out there and buy another 18 shares. You have to, just get up to 100.
So how do we find out if a stock is optional or not? Well, once we're on the Success Stock Market website, go ahead and just type in your ticker symbol for the stock that you're after. Type it in right up here in the top left corner, click on the Get Quote button, and up comes your chart. And then you just see right here if it says optionable, and click on the options, and up comes the options change. If an options quote comes up, you'll find out if it's optionable. As an example, let's just go to the website and see how we could just pick up a stock. And here's one that was in the news for us today. So I'm just going to type in our ticker symbol and click on the Get Quote button over here on the top left-hand corner. And up comes AOL. This is a stock that many of you probably forgot that was even trading anymore.
Right, yeah.
But AOL used to be the big daddy out in the business here.
It was.
If we look at the stock,
the first thing you see when you pull up a stock's chart is the intraday movement of the stock. And then as you scroll down, the next chart you're going to see is the stock on a daily chart. So it's usually a 6-month chart we're looking at.
Yep. So if we're looking at this one right through right now, we see AOL here at $31.90 per share. Look at that. Stock was down $5.62 for today.
That was obviously some news. That was pretty bad.
It just came out and the stock gap lower. But the reason I show you that right now with the stock over here at $32 per share, if you want to know if it's optionable, we can go up here to the very top and click on the options quotes right up here in the top corner. And as soon as we do that, up come the options quotes, and we'll just go out for the next few weeks. And currently, with this stock right now at around $31.90 per share, $31.90, that stock, somebody's willing to pay us right now, if we look at that, $5.10 a share to buy the stock at $32. So that's an options quote for a covered call trade. Someone's willing to pay us $5.10 to buy the stock at $32 per share. Wow, that's amazing. So we've got some different strike prices out here based on which one we're trading at. Different ones through here, but $32. Someone pays $5.10. That's crazy. And the reason I do it is because the stock is so volatile. It's dropping right now to the downside. But think about that. If this is your stock and you own the stock in your account, and you're going to hang on to the stock because you think eventually it'll come back up, it's just going through a quick overreact or some kind of a news.
And that's what most people do. Most people just hold on to their stock.
If you're going to hang on to it anyway, you're going to collect $5.10 per share just for hanging on to the stock anyway. So they're willing to pay this $5.10 to buy the stock right here at $32 in the next few weeks. So if that stock continues to drop a little bit before it starts to bounce back up, you still have $5.10 you collected, which means that you're just making some of that money back. That's really, really nice.
So writing covered calls in your own portfolio of whatever stocks you have, we're going to cover that approach. There's 2 different ways we look at it. So
Great strategy.
Yes.
So 2 methods for covered calls. We can write covered calls on stocks that you already own. And if you have some kind of a mutual fund, we're going to explain to you how to change the mutual fund to an exchange-traded fund, which is a mutual fund that trades on the stock exchange. So that's one way to write covered calls you already own, or to buy stocks, write covered calls on. So maybe...
Either you have stocks right now, you can take a look at writing covered calls, or maybe you just have cash. So if you have cash, we're going to show you how to go out there and find really good stocks to write covered calls on.
If you're a little bit older, maybe you already have a good-sized portfolio, you've been collecting some assets already, you might already be able to retire, and you just don't know it just yet.
Right, from the cash flow.
Someone's willing to pay you cash, and so by the time we're done with this bonus DVD you're on right now, you might find out you can actually write a covered call as of tomorrow and make your entire monthly income by just writing one covered call.
Wow.
Wow, that's amazing.
Yeah.
You see it happen all the time with the live classes.
Yeah.
And if you're a little bit younger, just kind of getting into the stock market, maybe looking for some income and growth on both of them, maybe we're going to teach you how to buy a stock, a good quality stock, to write a covered call on to receive both the income and the growth. Before we do that, we have to make sure you understand there are both risks and advantages to writing covered calls. Let's talk about these. First one is you could be assigned. And really what that's telling you is assigned just means that someone's going to buy your stock. So if we're taking a look at a stock like ESV, trading right around $58.50 a share.
And you sold the cover call at $60.
$2.65, received $2.65 to sell the cover call at $60 per share.
So you might get an email that says you've been assigned, which means someone's going to actually take your stock away at the strike price that you sold. So they're going to go ahead and take the stock out of your account, and what you're going to see is all that cash sitting in your money market now.
Yep. So that just means that somebody actually bought your stock. So if you're assigned, it's your broker calling you and say somebody just bought your stock for you at $60 per share. That could happen. So that's one of the risks, that maybe you didn't really want to ever sell it, but somebody bought your stock. But don't be offended, because we're going to teach you how to buy that same stock back at a lower price.
Much lower price.
Yep. And if we think about it, all stocks that we take a look at anyway, not all of them go straight up. They don't just go straight up and down. When stocks trade, they go up, they go down, they go up, they go down, they go up, they go down. They kind of move back and forth.
And it's a nice trading channel, yeah.
So if you sold that stock over here at 60 and somebody bought the stock at 60, just wait for that next pullback, and as it pulls back,
very high chance it's going to come near back there for that price.
Almost all stocks, they go up and they pull back. So wait for the very next pullback and then buy it again. So don't be offended if somebody actually bought your stock at 60, because all it means is you made a profit, and everybody hates to make those profits.
Well, and most people, the problem is you're going to find when you sell your first covered call and you do get called out, is what it's called, you're going to find you're a little emotional, like, wait, but I love that stock. No, folks, we only put money into the market for one reason, and that's to make money. If you've been holding a stock for a period of months or possibly even years,
you're
and
probably
it hasn't,
emotionally tied to it. At that point.
Yeah, you are, and it hasn't been making any money for you, it's now time to make your money start working for you, and by selling that covered call. And if you sell a covered call and you get called out, it means the stock probably went up a little bit so you could get called out. So you received money to sell the covered call, and then you sold your stock at a nice profit.
A nice higher price, you bet. So the other drawback to this is you could lose potential profits if the stock rallies, and maybe the stock goes straight up. We look at stocks sometimes. I've never really seen a stock go straight up forever without a pullback.
Right.
So don't worry if it goes up. Stocks are meant to go up, but sometimes they go up and sometimes they pull back. So when they do pull back, go back and buy that same, if you like that stock, buy that same stock again on the very next pullback.
Or maybe it's really, maybe it's kind of serendipity. Maybe you want to be out of that stock and go find specifically a stock that has maybe a more predictable trading channel and give you higher premiums.
Absolutely. Or you could be stuck in a downtrending stock. Maybe you've got a stock in your account that's just in a serious downtrend.
Three red arrows everywhere.
Red arrows. But the good part about that is that you can still write cover calls on the stock or sell some calls against it and bring in some income, some cash as that stock is dropping to the downside.
That's if you wanted to keep your stock, yes.
Some advantages, potential monthly income. You can get a monthly paycheck month after month after month after month just for writing cover calls on stocks that you own.
Yeah, you sell the call option within 24 hours. That cash goes into your brokerage account, and I actually have mine set up where I can just go to it's ACH transfer. I click a button and they transfer it directly from my brokerage account into my checking account. Pretty nice.
You have some downside protection. So we're looking at AOL and that last stock we just looked at. So even if AOL continues to drop, someone's willing to pay you right now $5 a share to buy the stock at the current value. So even if it does drop, nobody will buy it from you, but you still get to keep that $5 per share.
And if you're a more conservative person and you want to just, slowly grow your portfolio with some really good quality stocks, cover calls is a great way to actually grow that portfolio as well. So you don't actually have to take the income. You leave it back into your account to buy more shares.
Yep, and they can be used to grow your portfolio. Absolutely. So great strategy. Now, assignment, what that means, and so you might hear that term, we just want to make sure you understand it. All assignment means is if you went back and bought that ESV stock we looked at here for about $58, and you sold the $60 call and received the $2.65, if somebody decides to buy that stock for you at $60, you've been assigned. And so that just means you're forced to sell the stock at $60. That's just going to happen. If it does
just means you sold your stock.
And if it does happen, it happens overnight when the markets are closed. So you'll get a call from your broker in the morning and say, hey, your account has just been assigned.
Or an email is what you'll probably get first.
And there's nothing for you to do. All it means is whatever you just did in the contract, you allowed someone to buy the stock at $60. They chose to do it, and they bought the stock. There's no follow-up from you. There's nothing you have to do. It's already done. The stock is out of your account, and there's just a whole bunch of cash in your account. So now you just go back and look for another good quality stock and do it all over again. You can also buy back the short option during the daytime to cancel this, and that's something you'll learn later. And all it really means is if your stock's going to go up and you originally sold the $60 call on ESV, you can now just place an order to buy the $60 call on ESV, and it cancels that part of the trade out, and you have left in your account is just the stock. That's something you learn a little bit later on, maybe your 3-day class you go to with us, but that's just some of the options you have. So, and also, you can be assigned early, which means that even though you sell the January $60 call on ESV, somebody has about 4 weeks to decide if they want to buy the stock at 60. They might decide in 1 week they want to buy the stock at 60, and so the whole process is now done. But that's actually good news. Because think about it. You've made all of your profit in 1 week, 4 weeks. So what do you think you're going to do now?
Now you can out for the same month. You can go back and find another trade.
Yeah, you make almost twice as much in that period of time because you did it twice.
It's really good news.
That's actually good news. That's a smiley face income right here.
Yeah.
So that's something you actually want to happen. It very rarely happens, but if it happens, be happy about it. You could be stuck in a downtrending stocks. Most investors don't know. We were just kind of taught to buy a stock, and that's all that we're done. We're taught to buy the stock, hang on to it. It's a good quality stock, and you're going to own it forever. And so we don't know anything else to do with it. And then we learn a basic cover call strategy. Hey, I think I'm going to write calls against the stocks that I own.
Well, most folks don't even know how to sell a stock. Most people just get into it and go, I'm holding it until I don't know when. So at least now we're saying, gosh, when you sell that covered call, maybe you sell it at resistance every time. So when the stock hits its highest point, its resistance area, the ceiling, maybe then you get called away. So wouldn't it be nice to actually, if you were in a stock, to sell it when it hits that resistance or the high point?
Mm-hmm. And so there's going to be some really good times to sell the calls on these, and we're going to show you that in just a few more minutes. You can also avoid some very large losses with stock depreciation by selling calls against it. So even though your stock might be dropping, you're still getting paid cash for somebody to buy a stock at a higher price, which they're not ever going to buy as the stock's dropping to the downside. So if you say, I'm going to hang on to the stock, maybe it's a work stock, and you say, I can't sell my work stock. There's no way I can do that.
Right.
But I can see that my work stock is dropping in value. You don't actually have to keep those losses because you can actually offset those by writing calls on those. Mm-hmm. And we know that sometimes a downtrend can last a while, which is one of the reasons we're going to say that as you start writing covered calls on stocks, you want to only use the good stocks off of the Success Stock Market website because those are really good quality, fundamentally sound stocks. And those stocks are less likely to have any sustained
the major drops. Yep.
It's kind of like a child that has a report card. If your child always has a good report card and they come home with bad grades, they're less likely to have bad grades for the rest of their life. Maybe they just went through a little bit of a slump. Mm-hmm. So a good quality stock has a better chance of heading right back up again. All right, potential monthly cash flow. Now some of the benefits. Those are the risks. Now let's cover some of the benefits. Most investors already have some kind of a stock or a mutual fund.
Yeah, in fact, most people have mutual funds. They don't even know what they have to begin with. But it's a really nice process that you can do this in any type of your account. If you own mutual funds, you can very likely convert those over to an ETF, which is a mutual fund but trades like a stock.
Yep. So most investors already have a stock, or they have a mutual fund in the account, which can be traded with ETFs, like Stacy just said. And we're going to teach you when to sell those calls on those stocks. We want to do them when the stock is at resistance, which just means it's already up at a little bit of a high. And the indicators are starting to turn a little bit bearish. Those would be our Colville indicators, our MACDs, or our moving average arrow on the actual stock price chart itself. So we start to get some red arrows. When that happens, when you start to get those red arrows, your stock is about to pull back. That's exactly when we want to start to write those cover calls on here. So we're going to teach you how to do that. So provide some potential monthly cash flow. You can also get some protection and growth off of cover calls. This can be used as a protection strategy. So if your stocks you own are not maybe in a real bad downtrend, but just like slowly trending lower, just kind of slowly melting away the profit.
Well, and maybe maybe it's only in a 3-month downtrend. At least in those 3 months, you can at least offset the price of that decline by selling a call, a juicy call premium in the money. So, and if calls are coming up. If your stock is coming up on earnings, which we list on the stock searches, you'll see when we put earnings dates on there, stocks can take a pretty wild move around earnings.
Yeah, they can have a major jump to the upside or a major jump to the downside. And that's probably what happened with AOL. I didn't check the news on it. We looked at the stock, had that major drop to the downside. They might have reported earnings today, which come out every quarter, and maybe they didn't do so well in the stock drop. And the last one here. Cash flow can be used to purchase new stocks. So instead of actually taking the cash and pocketing the cash and writing cover calls each month, maybe decide to reinvest it and buy some more good quality stocks each month.
To build up your entire portfolio.
To help build your portfolio even faster. Yep. So cover call checklist. Find or increase
the portfolio potentials.
ETFs. So this is our check. We're going to follow these 5 steps here. We'll talk about what each one of these steps are. Identify the correct timing.
And because timing really is important. A lot of people might say, I've tried the covered call thing, but it didn't work for me. They probably just didn't follow the correct steps. And one thing we have with our website is, folks, we show you the trend. We show you the support resistance. We show you some arrows. The tools you have are absolutely phenomenal. These are tools that professional traders use to help identify their entry of their correct timing and where their exit. Where do they actually sell the call? At what price?
Monitoring the trade and closing adjustments. These are the 5 steps. You might want to just mark this price down or this time down on your video and say what time is it, because these are the 5 steps you always want to make sure that you're always following when you start to write your cover calls on here. So let's talk about each one. Find or increase potentials. First thing you want to do is you want to go through your current portfolio and find out what stocks you own are currently optionable. That's where you'll just go back to type in the ticker symbol on the website, click on the options link, and see if the options quotes come up. If they are, you have an optionable stock that can now be used to write cover calls on. You then want to see, do I need to increase the amount so I have a block of 100. Because remember, in order to write a covered call, you have to have 100 shares for every options contract you sell. So if an options contract you sell is at $2.65 per share, that's really $265 for one contract because it's good for 100 shares. So if you don't have, maybe you have 87 shares of a stock, you got to go out and buy 13 more shares, so now you have 100 shares at a time.
In fact, from now on, whenever you buy stocks, you should be buying stocks in 100-share increments. Don't buy them and don't say, I want to buy $2,000 worth of $5,000 worth. So I'd like to buy X number hundreds of shares. Because the nicest thing about being in a stock is you can turn that into that cash by selling a call option.
Then take a look at your current mutual funds that you have and say, I've got a mutual fund. I think I want to go ahead and convert that to an ETF. Changing these to an ETF, and we're going to show you how to do that and what that entitles.
In fact, what ETFs are, if you haven't seen them before, we have a really good section on this in the 3-day class that you're going to see us teach. And what the ETF is you can take your money and diversify it just like a mutual fund. Your one share goes in and you buy a piece of every single stock in the entire portfolio. But we have on our website some of the top ETFs. Of the major indices. You want to go take a look at it?
Okay, let's go take a look at it. So to get that, we're just going to go back to the Success Stock Market website and click on the IT Mutual Fund link over here. And then on the left-hand side or the top of the page here, we've got, top one here is SPY. Now the SPY is the S&P 500 ETF. Now, this is an ETF. An ETF is just a mutual fund. It's called an exchange-traded mutual fund. It's an exchange-traded fund, a mutual fund that trades on the stock exchange. Now, because it does, it's also optionable, so we can actually go out and
trades like a stock.
And start trading it just like a stock does, so it makes it really nice for us.
So for one share, at this point, $141, you're buying actually a piece of every single stock in the entire Standard & Poor's 500 top stocks in the U.S. economy.
So you buy one share at the current price of $141.45 a share right up to the top here, and now you own, like Stacey said, all 500 shares of the S&P 500. Makes it really easy for you. So what's good about this is that by owning just this one share, you have the benchmark for the marketplace. This is whenever people say, how much was the market up this year or last year? They're really talking about the S&P 500. And here's what's kind of nice about this. I don't know if you know this, but if you actually go to the #1 rated mutual fund website in the entire country, it's Morningstar.com. They do a fantastic job with mutual funds. We look at some mutual funds, but we trade more on the ETF side because it has many more advantages. But for the mutual funds, Morningstar.com, you can actually look at what the average of all mutual funds in North America, what's the average rate of return, and you'll find out that the average rate of return for all mutual funds in North America for the last X amount of years do not outperform the S&P 500.
Isn't that something?
Because they have all the front-loaded fees and back-loaded fees. So
and annual fees along with that.
And so if you wanted to actually outperform the majority of all mutual funds, you go out and buy one share of SPY, and now you're your own mutual fund manager, and you are the benchmark that everybody's shooting for, and you're actually doing a better job than professionals are.
And this is optional.
And it's optional, so we can write cover calls on it. Now, if you wanted to do the mutual fund for the Dow Jones Industrial Average, you can just click on DIA up here across the top for the Dow Jones Industrial Average, or QQQ is the ETF that tracks the NASDAQ. And then we've got IWM, which is the ETF that tracks the Russell 2000.
The smaller companies.
Now there are hundreds and hundreds of ETFs. You can find an ETF for almost everything out there.
Almost every sector out there.
If you have a mutual fund you like right now, just find out what that mutual fund tracks. There's probably an ETF that does the exact same thing.
In fact, they even have ETFs of China if you want to invest in very specific countries or specific sectors. But the benefit of a mutual fund or an ETF is you get the diversification of numerous different companies out there. So we're taking it one step further and saying if you want to stay conservative, great, stay with that diversification, but now start writing the covered calls. And a lot of them do pay dividends, too.
And so you can do the same strategy, increase your potential. You can do the same thing. You might not be thinking about it, but maybe instead of just a brokerage account, you might have a trust or an IRA, a Roth IRA, simple IRA, anything like that, a retirement account. You can do covered calls in all of your retirement accounts. There's nothing stopping you other than maybe your brokerage firm, but the Securities Exchange Commission, the SEC, we're completely fine with that.
In fact, you're going to find that there are so many ways you can trade your IRA that you didn't know. In fact, most people forget what's in there. They go, I'm not going to touch it till I'm 59 and a half or older. But there's so many things you can actually trade inside your IRA to kind of kickstart your returns to get them up and going. And really covered calls is the first way. Yep.
And if your broker says you can't do covered calls inside your IRA, all they're saying is we don't do that. So it just means switch brokerage firms is all it is. There's hundreds of them out there that will do that just fine.
And when you come to the class, we'll talk about that as well. The different brokerage firms and the commissions you might have to pay, for each type type of brokerage firm.
So ETFs track mutual funds, and they are an actual mutual fund, but they trade on the stock exchange. They trade exactly like a stock does.
Yeah.
They're long, which means you can buy them, short, which means you can sell them without owning them, and they're optionable, which means we can do covered calls. Many of them actually pay dividends, so you can even collect the dividends on them.
That's
They're
nice.
diversified. They can be used to replace your mutual funds, and you'll find out that most investors, especially the professionals, no longer even touch mutual funds. They go more towards the exchange-traded funds because there's so many more things they can do with those to help manage their portfolio. You can even use these as an entry into commodities. So maybe you say, I'm watching the price of oil go up and down right now, and you can actually track the ETF that tracks the price of oil.
You can buy that, yeah.
Is USO, and it tracks the price of oil. Or
gold.
You
can track gold, yep.
Huh?
If you wanted to invest in precious metals or silver, there's ways you can do that with your ETFs and still be very diversified. And, again, because they're ETFs, most of them are optionable, so you can write covered calls as well.
Really, really makes it nice for us.
Boy, you're kind of getting to a sophisticated investor. Someone says, well, how do you invest your IRA? Oh, I invest in precious metals, and I sell covered calls on that. I'm diversified.
Sometimes I look at some of the commodities, and I move into the commodities markets, and then
they're going to think you're really smart.
And occasionally I diversify into big blue chip stocks with the S&P 500.
Yeah.
A little bit of everything. All right, so here's an example of just how the SPY tracks the S&P 500. The very top graph here is the actual chart of the S&P 500 over a 6-month time frame, and you can just kind of see which way is that going.
Overall,
on this one here was up.
Yep.
But here's the bottom chart here is the exact same chart pattern anyway, but it's for the ticker symbol SPY, which is the S&P 500 ETF. It's the mutual fund that tracks it on the stock exchange. And hopefully, without us giving you too much of a push here, you can see the patterns are just about identical. So if you really wanted to own the top 500 companies in the S&P, you could just own the ticker symbol SPY, which is optional, or you could go out and track any other ETF that you want that trades like a stock. So they're actually a very, very nice and simple way for us to trade and to make some money that are really great for professional investors. All right, so now, step number one, we're on our 5 steps to making some cash here. We want to find or increase the stocks in our portfolio to make sure we have 100 shares at a time, or buy some ETFs, or transfer our mutual funds to ETFs so that we can write some cover calls.
And there should really be little or no cost to doing that. It should be a very, very small fee, if anything.
If your commissions are more than about $10 or so, then you're really paying more than you need to at this point of time. Most of the really good online, if you just do a nice Google search, say what are the best online brokerage firms, you'll see they rival any other brokerage firms out there, and their commissions are right around $10 or so, maybe a little bit cheaper.
So now we need to take a look at the correct timing. And timing is really the key. The professionals, again, like I said, we go back to taking a look at the website where we have our entries and our exits, our supports and our resistance. By identifying the correct timing, you're going to you could potentially even increase your rate of return by buying your stock near the support area and look to sell the call near the resistance area.
All right, so we're identifying our timing, and here's a stock. We're just taking. We found a stock right off the website here, off the Success Stock Market site, and we just looked at for a good quality stock, looking at Suncor Energy, ticker symbol SU. And so we talk about when's really the best timing to write a cover call, and really the best time to write a cover call, if you own the stock and don't want to sell it, the best time is right after it's bounced or made a move higher, and is now starting to pull back to the downside. So if we're looking at our stock, what we notice here is that we draw some automatic lines across the top. These are called resistance lines or ceilings. And whenever the stock hits these levels and starts to pull back, it's telling you your stock's about to drop. Now you combine that at the same time with this nice little red arrow here, and it's kind of just like almost putting it in our face. Hey, our stock just stopped moving higher and gave a red arrow.
Well, and not only is it red, but it's pointing down, which means the stock probably isn't going to be headed up at this point.
Yeah, so it doesn't mean it's going to pull back forever, but it just means at this point it's probably going to pull back, maybe somewhere down and through here, a little bit of a floor, and then start to bounce up again. So we can just see at this point our stock is starting to drop a little bit. So whenever your stock hits a ceiling, the green line is now drawn for you automatically, and it just means it's pulling back, and you get a red arrow. That's the time you want to write a call option against this, because now someone's willing to pay you cash to buy the stock, but even as it starts to drop, they're never going to want to buy it at a higher price, so they can still go back and do that. So we now have a couple of choices. We can write a call option on here. We could either say, hey, I'm looking at the option, and I can sell the $34 call, or I could sell the $35 call. And that's really based on if you're more aggressive or more conservative.
I would sell the 34. What would you sell?
Yeah, Stacy would.
I would sell. Mike would probably sell the 35. I tend to be
a little bit more aggressive, I'd say, is what you tend to be. Is that what you're going to say? You tend to be a little more aggressive.
And you tend to be a little more conservative.
But I sleep really well at nighttime.
But you know what? I have a lot more money.
Ooh, I don't know. Well, this thing just got really just turned up all of a sudden, didn't it? So here's what we got here. So Most options trade in $1 strike prices. So right now, someone's willing to pay you $34 or pay you cash to buy the stock at $34, and somebody else is willing to pay you cash to buy the stock at $35. You can choose which one of those you want. For this example, on this what we're doing here, we're going to use the $35 call. And again, this is just for educational purposes only. But we're going to say right now, there's a good chance that as my stock hit the 34 ceiling and it's starting to drop right now, and I've got a red arrow, there's a good chance no one's going to want to buy the stock way up here at $35 a share. And as long as the stock stays beneath that, I'm just going to collect somebody's cash.
Well, and the reason would be to sell at 35 is, let's say if you didn't want to sell your stock.
Correct. If you own the stock and don't really want to sell it,
then you'd sell 35. I don't mind getting called out because it just frees up my cash at that point. They take the stock away. I get all the cash. I go find another trade. So I actually like to go for the $34 call.
Because it'll pay you more money.
Yeah.
And the reason it'll pay you more money because there's a higher likelihood it could actually hit there, so someone's going to pay you more cash for that.
Exactly.
But then it just depends on what you're after. You want conservative, you want some cash flow. Both of them are great strategies. If you don't, like Stacy said, if you don't actually mind if the stock does happen to pop up real quick, if you don't mind the stock going above 34 and selling it, you'll actually get paid more money for selling the 34 than 35s. If you want to have a less likelihood of somebody buying your stock, then you do the 35s, but you also receive a little bit less cash. So let's go ahead now and we click on the options quotes to bring up the stock that we're looking for SU, and again, educational purposes. And right now, at this moment in time, what it shows us is that somebody's willing to pay us 58 cents per share to buy the stock from us, 58 cents per share to buy the stock from us.
And remember, we have to do at least 100 shares.
And we have to have 100 shares. So right now, with the stock at 32.5, somebody's actually willing, as long as there's a price is listed, the bid is where you always sell, the ask is where we buy. And as long as a price is listed, you have a buyer that says right now that I will, if you want to sell, they're going to buy this from us. So right now, somebody will actually pay us 58 cents per share to buy the stock at $35.
Now, you might be thinking, who would do that? It doesn't matter who's doing that. It's usually the market maker. The point is, these are available out here every single month.
Now, by the way, if you don't do this, and you leave your money sitting there, understand that the big institutions are doing these types of strategies with your cash. And the reason that when you give them a mutual fund, how do you think if the mutual funds don't ever outperform the marketplace, how do you think the big mutual funds have all that cash and pay for all the expenses on all those jets and planes and bonuses and everything they have if they're not making any money? And the answer is because they're doing this type of strategy and other things like this with your cash, which is why they want you to buy a mutual fund and just buy and hold and not do anything with it.
Let them manage it because they know how to do these strategies.
Correct.
Because as a professional trader, you know how to go in there to increase your returns. And by doing this just for the 1 month, you can actually increase your return on the stock just not only with this 58 cents, but let's say the stock does go from 32.50 all the way to 35. You sell at 35, where at its highest point it's been at in the last 6 months.
And you're still going to make another $2.50 from the current price all up to 35. You make $2.50 plus you're going to keep another 58 cents per share on top of that.
That's a really good return.
Yeah, it is nice, and that's your money from the point that you write that return. That's your cash from that point going forward. That's a really nice looking trade.
That one trade, if that actually did go up to 35 like that, that would probably outperform your entire portfolio as far as rates of return.
It probably would. If you think about that, you bet, because you'd be making about $3 on a $35 investment
almost
here.
9%.
9% or so, and I doubt you're going to get 9% for the market this year.
Yeah.
That's pretty decent for just 1 4-week trade.
Well, and just by taking the very first step, this is the very first step, folks. Wait till you actually have done this a few times and learned a few more other types of strategies out there. And so you can see you're now on that path to learning, how to manage your portfolio to that financial freedom.
Yep. All right, so cover call checklist. The first thing you do is you find the stocks in your account that are optionable or increase the ones you have so you have at least 100 shares and then move over to some ETFs. Then you want to identify the correct time to sell a cover call. And the correct time to sell a cover call on stocks that are currently in your portfolio is when you think they're about to pull back a little bit. So look for those red arrows start to pop up a little bit.
When they're at resistance and kind of rolling over.
Correct. The next thing you're going to have to do is you're going to have to sell the call option. You're going to actually have someone pay you cash to buy the stock. You think, why would they do that? And the answer is just because they have to. You'll learn more as your education increases and you take different classes and you'll find out all the different kinds of strategies available to you. But right now, just understand they have to. They've got to pay you the cash. Whether or not they want to tell you about it or not, they've got to give you the cash. So we're going to sell the call option. So here's how we do this. You go to your brokerage account, you click on the trade button with your broker, or you just call your broker if you don't have an online one. Now, we do recommend as you do these, and we can't recommend what stocks trade because we're an educational company, but we do recommend that if you're going to trade options, because we can do this part, is that try not to pay too much in commissions. And the average commissions these days should be around $10 for an online trade. If you're paying a whole bunch more than that, then you're just paying more because your broker wants you to pay more. It's just not necessary. It would be like walking into McDonald's and saying, I'll pay you $45 for that hamburger. It's just not necessary at the fast food restaurants because that's not their price structure. The online brokerage accounts these days do everything full service ones do. It's just not necessary to pay the high prices anymore.
Yeah, and folks, if you can send an email, then you can sell an option online, because really we're just going to be filling in the blanks here. You can see it says this, we put in the stock symbol, we put in the option expiration month, and you put in the strike price that you're willing to sell the option at.
This is for, we're going to sell SUs, our stock. We're going to sell the January $35 call options, which means this is the expiration month, and this is the strike price. So just like your option quotes. Now we're going to sell to open, which means we're going to sell an option we don't have and open up a new position. We're not selling the stock, we're selling the option.
To cover the stock.
And now it says, how many stocks do you have? Well, maybe you've got 500 shares, so you're going to do 5 contracts.
Maybe you have 1,000 shares, but you're only going to do it on half. Because by doing it on half, now you can just say, let's just give this a try and see what it's like. And then you go, crumb, I could have been doing this for a long time.
Crumb was probably the word I was thinking of too.
Yeah.
All right, so we're going to sell 5 contracts for 500 shares at a limit of 58 cents. This doesn't mean we're selling the stock. We're selling the option, and when you sell the option, we're bringing in 58 cents. That's what we're doing.
Per share.
So now it's 3 parts of all options contracts. An option gives you the right to sell a stock at a set price before it expires, and you receive a premium to do so. That's your options contract. Now it says duration, how long is the order good for? And this is 1 day. Now all this means is if you place this order at nighttime when the markets are closed, the duration is good for 1 trading day. So the markets are open 9:30 a.m. till 4 p.m. And so if you place this at night, it's good all day the next day. If for whatever reason, let's say that this option opens up at 63 cents in the morning, you'll actually get filled at 63 cents versus 58 cents. If, however, this option opens at 55 cents, you might not get filled at 9:30 in the morning at the open. But maybe before the end of the day, you'll get filled at 58 cents because
all that fluctuation throughout the day.
And the options change all day long. So you're giving the options market maker all day to fill that order at 58 cents. If you don't get filled at the end of the day, the whole order just evaporates, goes away, no charge. Do it again the next day.
Yep. And the nice part about this whole strategy is, even though you go, wow, this is a whole new strategy, I'm getting real sophisticated in the market. Folks, you have your stock, you sell the call option, and then all you do is once every night when the market's open, you take a look at the market. During the week, when the market's actually closed at nighttime, you take a look and say, did I get filled or did I get called away? And then you don't really have to do much more.
Yep. So now, our covered call checklist, we've identified the stocks. We picked the right time. We sold the call. By the way, that was $290.
Into your account.
Into your account. And by that $290 goes into your account that very same day that you sold it. And the very next day, you can take out and spend it because that money is yours from that day going forward. And no matter where that stock goes, up, down, or sideways, you never, ever have to give that $290 back because that was the money someone paid you for the right to do something.
Yeah.
So what are you going to do now? So the very next day, I'm calling my broker and say, send me my check. I need to make a credit card payment.
Or I have an ACH transfer, so I just go in there and hit transfer $290 to my bank account, and then bam, it's done.
I don't need the money as quickly as you do, so I'm willing to wait 3 days for them to send me a nice check so I can smell that paper money check.
I'm a technology maven, so I like to have things done as quick as possible.
Okay. So then we sell a call option. That's your money that day, by the way. So many of you right now are thinking, and here's what kind of gets me, because I think about this, and you might be thinking the same thing right now. Think about how long you've had stocks or mutual funds inside your brokerage account right now. How many years have you had those? And then multiply those years by 12 months. And how many paychecks have you missed over the last 30 years on a monthly basis that nobody's given you?
We're not trying to press you. We're trying to open your eyes.
Yeah, no pressure here and no depression here. We're just trying to make you excited about
we're trying to help you change your mindset. This is something you can do. This is something that everybody can do. And nobody tells you this because, as Mike said earlier, it's in no one's best interest to teach you this stuff. And that's why you're coming to the 3-day class. We have a lot of really good stuff and the tools you already have. And by even just taking a look at your account, maybe you just say, I'm just going to do covered calls for the rest of my life. Fabulous. You're probably going to outperform almost every other money manager out there just with the tools you have, finding the high quality stocks and selling these monthly calls.
Yep.
So we're just trying to change your mindset from where you were in the past of not knowing what to do to now saying, wow, I have a choice and I actually know what to do with that choice.
All right, so then we're going to monitor the trade. So now that we're in the trade, we're going to monitor it. And as long as this stock stays beneath this $35 level right here, this $35 with the strike price we sold, there's nothing to do. So between now and the third Friday of January, which is when this option expires, somebody has the right to buy my stock way up here at the top at $38 a share.
$35
a share. So if it never goes up here to $35, they're going to choose not to buy the stock.
Right.
They're just going to let their option expire. There's nothing for me to do. The option just completely expires.
Dissolves away.
It dissolves. There's no follow-up. And now at the end of the month, you still own your stock and you still own your $290, and you're thinking, I'd like another paycheck. So I think I'm going to do it again. And you just do it again and again and again.
This is when you get excited on Sunday night. How many of you have been excited Sunday night? Go, yes, I can't wait to go to work on Monday.
Yep.
Because Monday, when the market opens, now that the third Friday, your option has expired, you can now go write another option.
So again, all we're doing here is we're changing our mindset from an employee mindset to an investor mindset. Remember, an employee will take a look at this and say, I'm just going to buy that stock and own it for a long period of time and want that capital growth appreciation. An investor will say, I want to own that same stock. I want the long-term growth capital appreciation, but I also want monthly income to pay my bills. I'm going to rent out that house if I buy that house as an investment. Mm-hmm. I'm buying my stock as an investment, so I'm going to rent it out each month as well.
In fact, if you take a look at this chart we're looking at right now, it had some great growth for 3 or 4 months, but then it stopped and it went sideways. Its trading channel went from an upward trend to a sideways trend.
Yeah, there's a new pattern right now.
And we take a look and say, gosh, this stock really hasn't done much in the past 3 months. In fact, whenever it hit 35, it turned and reversed immediately right back down within 2 or 3 days.
Yep.
So it's nice because by seeing this, anybody who's going to buy and hold this is not making anything. But by you buying and holding this and letting the stock move from its support to its resistance, you're actually getting that option premium as you sell that option near resistance.
Okay. So now we're going to
monitor
our position. As long as the stock drifts slightly lower or sideways or even up a little bit, there's no change for us to do. There's absolutely no follow-up. There's nothing to do. But each night I'm still going to look at the stock to make sure I don't have to do something. And you think, well, when would I have to do something? Well, if it went higher, you don't really have to do anything. Let somebody buy it and then wait for the next pullback and buy it again. Mm-hmm. If, however, it starts to really, really drop and go to the downside and really start to sell off, you're probably going to want to consider maybe even just closing the entire trade and selling the stock.
Yeah.
And to do that, you'll first have to buy back the call option you sold. Your broker will show you how to do it. It's a very simple process. Tell your broker, I want to close the cover call trade. He'll tell you exactly what to do.
You want to exit the entire position.
And then you can sell the entire stock and be done with the whole thing. You don't have to wait until the third Friday of the expiration month to do that. So you can always consider closing it out if you want to by monitoring the trade. So now we found the stock. We identified the correct time to do it when it starts to pull back. We sold the call option. We monitor the trade, and you monitor it each night when the markets are closed.
Just once a night, whenever you want. It could be 2 in the morning if you want.
All you have to do is log on to it just really quick and say, okay, I'm looking at it. What's it doing? Nope, it's still not above the black line. It's not in a big downtrend. There's absolutely nothing to do. So then you move on to the next part. So all that's actually a very simple process. So if you own stock in your account, think about how much right now you could be making. Some of you might actually be able to retire right now and say, I'm not going back to work Monday morning. Don't say that because you watched a special bonus 1-hour DVD. I mean, that's not the reason you quit your job. But we're saying many of you might also already be seeing some possibilities in where you're going to.
Or so many of you folks have said, you know what, there's got to be another way that I could learn how to generate more income. A lot of people say, maybe I'll go to eBay, or maybe I'll learn to do a business. This is nice because you're already halfway there, folks.
And this might be something you do with those other businesses as well. Mm-hmm. Absolutely.
Yeah, you already have the stock, but by just taking the next step now and understanding how to write that covered call and how to do this on a repeatable strategy and actually how to search for stocks, which is coming up next. Our next thing we're going to say is if you just have cash and you put that cash to work, how do you actually find a stock that specifically pays you a high monthly premium and is in a very repeatable pattern for your trading channel?
So this is for somebody who doesn't already own the stock. The very first thing you're going to do is you're going to search for a really good cover call stock to write calls against. Mm-hmm. You're going to identify the correct time to sell the calls. Then you're going to actually sell the call, monitor your position, close it out. So this is the second part of this. So the very first one we're going to do is we're going to actually just go to the Success Stock Market website, and we're going to click on the good stock search, and we're just going to look for a really good quality stock. And we're going to start with a good stock first because a good stock is less likely to receive any kind of bad news. Mm-hmm. And if you're going to put your hard-earned money into a good quality stock, make sure it's one that doesn't have a possibility or one that at least has a better chance of moving to an uptrend. And a stock with good fundamentals is a stock that people are usually interested in buying.
And you're going to find that as you go through our website here, you're going to find that the stock search these are going to be stocks that you don't necessarily have been trading before. You don't necessarily are aware of these. Most people trade stocks because they heard it, a tip from a friend, or it's a big stock or a big story out there.
On CNBC, or I drive down past the street, or somebody,
or someone gave me a tip on this. And so, but those are stocks that typically have already gone through some type of a move.
Yeah, about the time that you hear about them from everybody else is usually about the time it's too late to jump into.
Yeah, it's the time to sell the call on that one.
Yep.
So you're going to find by using the Good Stock Search that we're going to go out there and find all the stocks, rate them on a very stringent scale with our fundamentals, and then look at the patterns of the stock. And basically, we're just teaching you a skill. How do you now use your skills into the market to create the income that you're looking for?
All right. You can also go to the Success Stock Market website and use the covered call column. We're going to talk about that, or other stock picks. You might have your own list of candidates, or maybe you heard something that was a brand new technology kind of going through news just coming out. So let's go to the website, and we're going to start by just going over to the covered call candidate site where it says covered calls here on the left-hand side. And every Wednesday, we update it every Wednesday and every Sunday, we actually put up a list of good stocks we think are good covered call trades. So, for instance, the first one, MGA. At this point, it's trading right around $46.43. Now, we're not recommending anything. We're just showing, let us do our picks from you and find some good stocks for you. So, MGA at $46.43. We're saying if you bought the stock right now at this price and sold the January $47 calls, you bring in 70 cents per share, and if a stock goes up, it's around 2.8% on your money, or about 20% a year if you did that every few weeks as the stock goes up. So if you scroll down the list, we actually write about what is this company, what is it that they do. It's listed as an almost good company on the stock scanner, and we go down a little bit lower, and we talk about its fair value, which is the Warren Buffett margin of safety price, what price he thinks is a good stock to buy the stock at or under, the analyst target price, and then we actually write out the trade. The trade is to buy the stock near the current price and place an order to sell the January $46 calls, what to do if the stock goes up, what if it goes sideways, and then we put up the chart on here, we kind of mark it up for you. And you can kind of see, if we just look at the stock, the lows have been getting slightly higher, and we're even giving you 3 green arrows.
Now, if you don't know what 3 green arrows are, again, we point them up, which is pretty bullish sign, but we also highlight the back of the stock chart green, which means it's pretty bullish at this point. And so, we've done a lot of...
Make it as easy as possible.
Yeah, exactly. We don't recommend anything, but hello, green, 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 up, 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 means it's probably not going to be dropping anytime soon.
Correct. So, and we say, what are the chances that stock could go right here to $47? Because buy the stock now and sell the $47 call option. That's a pretty good chance that's going to hit that price in the next few weeks.
Well, and in reality is, even if it doesn't hit that price, you can choose to do it a little more aggressive by selling the 46 call.
Well, yeah, even if it doesn't, let's say that it doesn't go up there, but you sold the calls and nobody ends up buying the stock, so you end up owning the stock still. What do you think you might do now? Let's do it again. I want another paycheck.
Yeah.
And you can just keep doing it over and over and over until finally somebody buys it, or maybe nobody buys it, and you end up just selling the stock and buy a different stock and go all over again and start with a brand new strategy. In
fact, what you're going to find is when you sell it, let's say you use this example. You buy the stock at $46.43. You sell the $47 call. You pull in that cash, and now you wait to the third Friday of the month. And now your significant other says, "Oh, how's your new business going in the stock market?" And you're like, "Honey, guess what? Our stock did nothing." Yes,
nothing. We're so excited. It didn't go anywhere.
Time to celebrate. We made money. Now, most people would say, "How did you make money when the stock did nothing?" And it's because you're now, again, stepping out of that mindset of the employee mindset to the employer, how you're putting your money to work for you like an employee and start creating cash flow off of your own dollars.
All right. So the second way to do this is just instead of going to where we do the work for you, go back and just click on the stock scanner right here. And from the stock scanner, just say, "Hey, I think I'd like to look for a really good quality stock." You can look at the 3 green arrows, upside breakouts, or some other ones.
There's a lot of searches.
But just click on good stock search.
At this point, let's just keep it as simple as possible, because many people overanalyze, and honestly, this strategy really isn't a super difficult one. Some people make it that way, but there's so many ways. We're just going to go ahead and try to find some of the best stocks out there. Try to find a predictable pattern, which would be nice, maybe a sideways trend is what we're looking for, sideways to up.
So here's how they come up. They come up with, we know that every stock on the list is a good stock because that was the search we looked at. Up comes the ticker symbol. Beneath the ticker symbol is the next earnings release date. And then across that, it has the name of the company, what's the average volume. We like to make sure it has at least a minimum of 100,000 shares. The more, the better. Is it optionable, which is important because we like to write cover calls on it. If it has a green check mark in here, it means it's trading under its fair value price, which is the Warren Buffett calculation, and under the analyst target price. So then you just take a look at the chart over here till you find a chart that you're interested in, and then once you do find one that you're interested in, you can go back and click on it and look at writing some type of a call option against it. So we're just kind of like scroll down through the charts here until you find something that you like.
And what you're going to find is whenever you look for stocks, you're going to look for a stock that has at least that is optionable, and you want to look for a stock.
Yeah, I like this one here. It's kind of
okay.
I can see I've got a low here, slightly lower, a higher low, and so I like this one. It's starting to move up.
So don't forget, at least 100 shares, and it's optionable. Those are two of the criteria from this point forward you're always going to look at whenever you buy a stock.
Mm-hmm. So the stock is currently at 23.68. Up comes the intraday chart, but I'm going to scroll down past the intraday chart and look at the daily chart, which is the end of chart, and I can see that by taking a look at this, it's actually got a nice pattern to it. The first thing you notice is what's the current trend, and the trend is a nice uptrend. There was my last low. Obviously, that was some kind of an earnings right here, some type of positive news, which had a big move to the upside with lots of heavy institutional buying.
Very good.
And then since then, if I'm just kind of watching which way this is going, I've got my lows are kind of going right up there. It's a nice positive
trend,
move. And even my highs
are also moving up in an upward trending channel.
That's called an uptrending pattern, so I like that. I'm also getting a nice uptrend with some green arrows through here on my Colville indicator, my MACDs. Those are moving up, so I currently have 1, 2, 3 green arrows. We're bouncing higher. I like which way it's going.
Yeah,
and
it's a good stock.
And so if we didn't own a stock to begin with, this would be a good quality stock, trading around $23.50 a share. To buy, it's in a nice uptrend. The fundamentals look really strong on it. And again, it's not a recommendation. It's just at the time of this recording, the stock actually looks pretty strong. So we'll go scroll up. We'll click on the options quotes. And from the options quotes, we'll go ahead and click on the options. And we'll bring up and say the stock is currently trading right now around $23.50 a share. And at this point of time, an options market maker will actually give us 50 cents a share to buy the stock at $25. How cool is that? Someone's willing to pay us 50 cents a share to buy the stock from us here.
When it hits resistance.
So if we buy it right here, they will pay us 50 cents a share to buy at a higher price. Now, if that stock, here's the good news. If it goes up, we will have bought the stock at 23.5 and sold it for 25, made about $1.32, plus get to keep the 50 cents over here.
Plus, you were in a short-term trade.
Right. And if it doesn't go up too much higher, it's still a nice uptrend. Maybe it only goes up a little bit. I'm going to keep the stock and write another cover call on it.
In fact, ideally, you'd like the stock to actually close at $24.99.
The perfect situation would be for the stock to close at $24.99, so I get to keep it
expiration,
and keep the 50 cents a share.
Yeah, exactly.
And then I can go ahead and sell the next month's cover call, and I'll get paid even more because it's closer to $25. So you get paid even more doing that. So this is a fantastic way to go back and do a cover call if you don't already have a stock. This is for more of a growth and income together
type of strategy. And keep in mind, so this was just going to the stock scanner, clicking on good stocks, and looking, again, we want something that's optionable. So by entering into that, you would look for stock that has a pretty good trend, it's sideways to up overall, and then you want to at least buy 100 shares.
Yep.
Now, folks,
very easy strategy.
It is. And when you come to the class, this is really just the tip of the iceberg, because you're going to find that when you come to the class, we're actually going to show you how professional traders buy stocks. In fact, the reason why I tend to be a little bit more aggressive and sell the strike price at more close to where the stock is price is because I don't mind getting called out because someone's going to actually pay me money to buy my stock back that I want to buy. So professional traders know all the tricks out there that are available for everybody to learn. And what Mike and I have done, well, actually what Mike has done, I take credit because I'm his sister. And so
she does. She takes credit everywhere I go. If I turn my back for a second, it's all hers.
So what Mike has done by putting this website together is he's taken the tools that professional traders like us use every single day and made it available to the general public. So by just taking your step forward and learning this one strategy, my gosh, you can really change the outlook of your financial future. But keep in mind, this is the tip of the iceberg.
Yep, you're going to learn quite a bit more of these strategies and other strategies at your 3-day live stock market class.
In fact, you're going to learn how to do this without even buying the stock.
One of the things we're going to show you is how to do that exact same trade we just looked at. Instead of paying $23.50, do it for about $1.50 per share. It's called the poor man's cover call, and we're going to talk about that as well.
Yeah, so a lot of people like that one.
If you'd like more information about some of the strategies in the class and maybe a personalized tour of the website, all the different features that are currently on the Success Stock Market website because it's just loaded with them, call the 1-800 number right here, and they'll walk you through the website and show you all the different cool features available to you.
Yeah, they are very, very good and very knowledgeable about the website. You have so many tools at your hands, and so go ahead and take take your tour of the website and go ahead and maybe start paper trading a couple days before you come to the class. Otherwise, you'll see either Mike or myself or one of our other instructors at our 3-day class. It's going to be fun. As you can tell, we like to have fun in our class. We like to give you the best education possible and empower you to change your financial future.
See you there, everybody. Bye-bye.
Bye-bye.